All right, so today we're diving into The Intelligent Investor by Benjamin Graham.
A classic.
Yeah, and we've got a pretty good spread of sources to work with.
Oh, yeah.
Yeah, we've got a couple of book reviews,
Okay.
one from Investopedia and another one from Dr. Vijay Malik.
Nice.
And then we've also got a blog post by Arav Patel
Okay.
and one more blog, this one by Miss Niao.
Interesting.
Yeah, so hopefully by looking at all of these sources, we can get a pretty well-rounded view of the core ideas from Graham's book, and then we can start to think about how those ideas can be applied today.
Sounds good to me.
So before we jump into the specifics of stock picking and valuation and all that,
Yeah.
one of the things that really struck me about Graham's approach is this emphasis on shifting your perspective. He wants you to see yourself as a business owner,
Right.
not just someone playing the stock market.
Not a gambler.
Exactly. So what do you think? How does that kind of fundamental shift in mindset actually play out in practice?
Well, I think it all starts with recognizing that investing is not about trying to time the market or outsmart everyone else.
Okay.
It's about making calculated decisions based on the underlying value of a business.
Interesting.
And when you view yourself as a business owner,
Yeah.
you're more likely to focus on those long-term fundamentals.
The things that really drive value over time.
Exactly.
So let's dig a little deeper into this concept of the intelligent investor.
Okay.
The Investopedia review really highlighted Graham's focus on intrinsic value.
Right.
So
Yeah.
how does that concept of intrinsic value play into this idea of being a business owner?
Well, think about it this way.
Okay.
If you owned a small business, let's say a bakery,
Okay.
you wouldn't just wake up every day and say, I wonder what my bakery is worth today.
Right.
You would look at the assets you own, the ovens, the ingredients, the location, the reputation you've built.
A brand.
Exactly. You'd assess the earnings potential, how much money you're bringing in, how much you could realistically grow.
And based on all of that.
You arrive at a pretty solid understanding of what your business is actually worth.
Okay.
Intrinsic value is about doing the same thing for publicly traded companies.
So instead of getting swept up in all the market hype,
Right.
you're really digging into the fundamentals of the business.
Trying to understand what it's truly worth based on its assets and earnings potential.
Now, one of the blog posts we read introduced this really interesting analogy of Mr. Market.
Yeah, I remember that one.
It was,
The Miss Now one.
yeah, that's one.
I liked that one.
Yeah, me too.
Yeah.
So for those who haven't read it, can you explain this idea of Mr. Market and how it can actually help someone make better investment decisions?
Okay, so imagine you have this business partner.
Okay.
Let's call him Mr. Market.
Okay.
And every day he comes to you with an offer to buy your share of the business or to sell you his quality.
Okay.
The problem is,
Yeah.
Mr. Market is kind of an emotional wreck.
Oh, no.
Yeah, sometimes he's super optimistic. He's euphoric. He's offering you way more than your share is actually worth. And other times,
Yeah.
he's completely depressed. He's panicking. He's willing to sell you his share for pennies on the dollar.
So it's like those wild swings that we see in the market
Exactly.
where prices are moving up and down, sometimes based on news and events, and sometimes seemingly for no reason at all.
Right, and the key is
Yeah.
to not get caught up in Mr. Market's emotional roller coaster.
Don't let them dictate your decisions.
Precisely.
You have to be able to detach yourself from those short-term fluctuations and focus on the long-term fundamentals of the business.
Because ultimately,
Yeah.
the intrinsic value of a company is not determined by Mr. Market's mood swings.
Right.
It's based on the real-world performance of the business and its potential for future growth.
So how can understanding this idea of Mr. Market actually help someone navigate today's market, which is, arguably even more volatile and driven by emotion than ever before?
Well, I think it starts with recognizing that the market is not always rational. Prices can move up and down for reasons that have nothing to do with the underlying value of a company.
Fear and greed.
Yeah, exactly. So when you see a sudden drop in the price of a stock that you've researched and you believe in,
Yeah.
don't panic and assume that something's wrong with the business.
Right.
It might just be Mr. Market having a bad day.
Oh, so you can actually use those irrational dips as buying opportunities.
Exactly.
That's interesting.
And on the flip side,
Okay.
when you see a stock soaring to new highs, don't get caught up in the hype and assume that it's going to go up forever. Take a step back, reassess the fundamentals, and make sure that the price is still justified by the underlying value of the business.
So understanding this idea of Mr. Market can help you avoid both buying high and selling low.
Exactly. It's about being a disciplined investor, not a slave to the market's emotions.
Now, both the Investopedia review and the one by Dr. Vijay Malik,
Yeah.
They both mention this distinction that Graham makes between two types of investors,
Yeah.
defensive and enterprising. So is this about picking a better approach, or is there something else going on here?
I think it's more about recognizing that there's no one-size-fits-all approach to investing.
Okay,
What works for one person might not work for another.
makes sense.
It depends on your individual circumstances, your risk tolerance, your time horizon, and your overall financial goals.
So tell me a little bit more about these two types of investors, the defensive and the enterprising.
All right, so the defensive investor is someone who values stability and prefers a more hands-off approach.
Okay.
They're not looking to spend hours poring over financial statements or trying to beat the market.
Got it.
They just want a solid portfolio that will provide steady returns over time.
So what kind of strategy would you recommend for a defensive investor?
Well, Graham recommended focusing on well-established blue-chip companies.
Okay.
Companies with a long history of profitability and a track record of paying dividends.
So you're looking for those steady eddies,
That's it.
companies that have been around for a while.
Yeah, and they've weathered different economic storms,
Okay.
and they're likely to continue paying dividends even when the market is down.
Got it.
And then on the other side of the spectrum, you have the enterprising investor.
Oh.
This is someone who enjoys digging into the numbers, researching individual companies, and is comfortable with a more active approach to managing their portfolio.
So they're willing to put in the work.
Yeah, they're not afraid to roll up their sleeves and do their due diligence.
Okay.
And they're looking for those undervalued opportunities, those hidden gems that the market might be overlooking.
So potentially higher returns, but also higher risk.
Exactly.
So it's not about one being better than the other.
Right.
It's about knowing yourself.
Understanding your strengths and weaknesses, your risk tolerance, and your investment goals.
And then choosing the approach that aligns best with who you are as an investor.
Exactly. There's no right or wrong answer.
Now let's talk about another concept that came up in a few of the sources. Margin of safety? Arav Patel's blog post had a really compelling example using the stock ROAR.
Yeah, I remember that one.
So can you break down this principle of margin of safety and how it can be applied to everyday investment decisions?
Sure. So let's say you've done your research.
Okay.
You've analyzed a company's financials, you've looked at their industry, you've assessed their management team, and you've come to the conclusion that their stock is undervalued.
You think it's worth more than the current market price?
Exactly. The
Right.
margin of safety is about building in a buffer,
Hmm.
a cushion, to account for the possibility that you might be wrong.
So you're not just buying at any price.
Right.
You're waiting for a discount.
Exactly.
Okay.
So in Patel's example with Roar, he estimated the intrinsic value of the company to be significantly higher than its current trading price.
Yeah.
But he didn't just jump in and buy it at any price.
Oh,
He waited for the price to drop to a level that provided a comfortable margin of safety.
interesting.
So even if his valuation was a bit off,
Yep.
he was still likely to make a profit.
Because he wasn't overpaying.
Precisely.
So it's about managing risk,
Exactly.
protecting yourself from those inevitable uncertainties in the market.
Right, because no one can predict the future with 100% accuracy.
This seems like a really valuable concept.
It is.
But one question that keeps coming up for me is, how do Graham's principles hold up in today's market? I mean, it's been, what, like almost 70 years since he first published The
Yeah.
Intelligent Investor?
Yeah, it's a different world.
The market has changed dramatically. Technology has advanced. Globalization has reshaped industries.
Right.
So are these concepts still relevant?
Well, I think that's where it gets really interesting. Because while the specific criteria that Graham used to evaluate companies might need some adapting, his core principles,
Yeah.
the emphasis on long-term thinking,
Okay.
on ignoring the hype, on focusing on value,
Yeah.
those are timeless.
So the tools and the metrics might evolve,
Right.
but the underlying principles of intelligent investing,
Those remain as relevant as ever.
because human nature hasn't changed.
Exactly.
We're still susceptible to the same emotional biases, fear and greed,
Yeah.
the same herd mentality that drove market bubbles and crashes in Graham's time.
Right.
So if we can learn to master those psychological challenges
Yeah.
and to focus on the fundamentals of value,
Then we can still achieve success in today's market.
even amidst all the volatility and uncertainty.
Exactly.
I like that.
Yeah.
It's about adapting those principles
Yeah.
to the nuances of the modern market.
Recognizing that the fundamentals of sound investing haven't changed.
Okay, so we've covered a lot of ground in this first part of our deep dive.
We have
We've explored some of Graham's core principles.
the importance of intrinsic value, the dangers of Mr. Market.
The distinction between defensive and enterprising investing, The power of margin of safety.
It's a lot to digest.
It is, but I think it's all incredibly valuable.
Absolutely. It is a lot to digest, but it's like the foundational stuff, right?
Yeah, it's like the building blocks, and once you have those in place,
Right.
then you can start to build a more sophisticated understanding of the market and how to navigate it.
Exactly. And one thing that I think is really important to remember is that Graham's philosophy is not just about picking stocks. It's about developing a mindset, a way of thinking that can be applied to any financial decision.
Oh, that's a good point. So it's not just for Wall Street wizards.
No, not at all. It's for anyone who wants to make smart decisions with their money.
Whether you're buying a house,
Right.
starting a business,
Yeah.
or even just deciding how much to save each month.
Those principles of careful analysis,
Yeah.
long-term thinking,
Understanding value.
all of that can be incredibly powerful no matter what your financial goals are.
Speaking of taking ownership, I was really intrigued by, I think it was the Miss Nio blog post,
Yeah.
where she described herself as like an aggressive investor,
Hmm.
which I thought was kind of interesting because it made me think about where I fall on the spectrum
Right.
between defensive and enterprising.
Yeah. Do you consider yourself more of a defensive investor or an enterprising investor?
I think I'm probably somewhere in between,
Yeah, I think a lot of people are.
but it's a good exercise,
Yeah,
right? To kind of like
absolutely.
think about where you fall on that spectrum.
Yeah, because it helps you to understand your own strengths and weaknesses as an investor.
So for someone who's just starting out,
Yeah,
who might be feeling a little bit overwhelmed
sure.
by all the information out there, all the choices to make,
Right.
what advice would you give them based on Graham's philosophy?
Well, I think one of the most important things is to not get caught up in trying to beat the market,
Okay,
trying to find that one hot stock that's going to make you rich quick.
right.
It's about building wealth steadily and responsibly over time.
And that requires a certain level of patience, doesn't it?
It does.
Because it's easy to get impatient.
Right. Especially when you see other people seemingly making money hand over fist.
It's tempting to think, oh, I got to get in on that. But Graham's philosophy is really about the long game.
It is. It's about tuning out the noise, remembering that Mr. Market is often irrational,
Yeah.
and focusing on those fundamentals of sound investing.
So do your research.
Understand the businesses that you're investing in,
Make decisions based on a rational assessment of value.
and then be patient.
Now, we've talked a lot about the defensive investor
Yeah.
and the enterprising investor,
Mhm.
but are there specific strategies or approaches that Graham recommended within those broad categories?
Absolutely. In fact, that's where a lot of the meat of the intelligent investor lies.
Okay.
He outlines specific criteria for selecting stocks,
Okay.
for managing your portfolio, and for navigating different market conditions.
So he goes beyond those general principles.
Yeah, he gets into the nitty-gritty of how to actually put those principles into practice.
Give me an example.
Well, for example, he talks a lot about the importance of diversification,
Right.
spreading your investments across a range of industries and asset classes.
Right.
So you're not putting all your eggs in one basket.
So that if one sector or one company takes a hit,
Exactly.
it doesn't wipe out your entire portfolio.
Precisely.
Now, one of the things that I found really interesting is how much Graham emphasized understanding financial statements.
Yes.
It's not enough to just rely on headlines or analyst reports.
Right.
You really have to dig into the numbers yourself.
He believed that intelligent investors shouldn't just rely on secondhand information.
Right. They should be able to read and interpret financial statements themselves.
Understand key ratios like price to earnings,
Yeah.
price to book,
And assess a company's profitability.
their debt levels, their overall financial stability.
It sounds intimidating.
It can be, but it's also incredibly empowering
How so?
because when you understand the numbers,
Yeah.
you're not just relying on someone else's opinion.
Hmm.
You're making your own informed decisions.
So it's about becoming financially literate.
Exactly.
Yeah.
And the great thing is that there are so many resources available these days to help people develop those skills.
Online courses, tutorials.
Books, articles, podcasts.
Yeah.
There's a wealth of information out there.
So it's not like a secret society.
No, not at all. Anyone can learn how to do this.
Now, one of the concepts that we talked about earlier that really resonated with me was Graham's emphasis on finding companies with a margin of safety.
Right. So we talked about that a little bit in the first part.
Yeah, we did. But I think it's worth revisiting
Absolutely.
because it's such a powerful principle.
It is.
So can you remind us how that principle can be applied in practice?
Sure. So let's go back to that example of you've done your research,
Okay.
you've analyzed the company, and you believe that it's undervalued by the market.
Okay.
You think it's worth more than its current stock price.
Yeah.
The margin of safety is about building in a buffer,
Mm.
a cushion, to account for the possibility that you might be wrong.
Okay.
Because no matter how thorough your research is,
Right.
you can never be 100% certain about the future.
There's always that element of uncertainty.
Exactly. So the margin of safety is about protecting yourself from that uncertainty.
So even if your valuation is a little bit off
You're still protected from potential losses.
because you didn't overpay,
Precisely.
it's about being prudent, not reckless.
Exactly. And that's a principle that can be applied to any investment decision, not just stocks.
Interesting.
So whether you're buying a house,
Okay.
starting a business,
Or even just lending money to a friend.
that idea of building in a margin of safety can help you avoid costly mistakes
Okay.
and protect your financial well-being.
So it's like a universal principle of sound decision-making.
I think so.
Now, we've talked a lot about the analytical side of investing,
Uh-huh.
the importance of research, understanding financial statements.
Right.
But Graham also recognized the crucial role that psychology plays in investment success.
Oh, absolutely.
He dedicated a significant portion of The Intelligent Investor to exploring the emotional side of investing.
Because he understood that our own biases and behavioral patterns
Our emotions.
can often sabotage our best intentions.
I think one of the blog posts described it as like Graham's book being brutally honest
Yeah.
about the pitfalls of human psychology.
Because it's easy to get caught up in the excitement,
Yeah.
especially when everyone around you seems to be making money hand over fist.
It's like that fear of missing out.
Exactly, and that's when people tend to make their biggest mistakes.
They buy into the hype at the peak of the market.
Right, and then they panic and sell when the bubble bursts.
So how can we avoid those emotional traps?
Well, Graham advocated for a contrarian approach.
What does that mean?
It means buying when others are fearful
Yeah.
and selling when others are greedy.
So it's about going against the crowd
Exactly. It's about having the courage to think independently,
and to make decisions based on your own assessment of value.
not on the prevailing sentiment.
Okay, so one of the things Graham emphasized was the importance of having a clear investment philosophy,
A set of principles that will guide your decisions.
regardless of market conditions or the latest trends.
Yeah, because when you have a philosophy,
Yeah.
it helps you to stay grounded,
Okay.
to avoid those impulsive decisions that can derail your long-term goals.
It's like having a compass to guide you through the fog of uncertainty.
Exactly. And that philosophy should be based on a deep understanding of yourself,
Yeah.
your risk tolerance, your time horizon, and your overall financial goals.
So it's not just about picking stocks.
No, it's about developing a framework,
Yeah.
a mindset that will help you make sound financial decisions in any situation.
Now, one of the distinctions that Graham made in the book was between investment and speculation.
Uh-huh.
He seemed to draw a clear line between those two approaches.
He did.
So can you elaborate on that for our listeners?
Yeah, so for Graham,
Yeah.
an investment operation is one that, upon thorough analysis,
Okay.
promises safety of principal and a satisfactory return.
Anything that falls short of those criteria is speculation.
Right.
So it's not just semantics.
It's a fundamental difference in mindset and approach.
Okay, so talk to me about that difference in mindset.
All right, so investing for Graham was about making calculated decisions based on a company's underlying value and its long-term potential.
So it's about becoming a part owner of a business
Exactly.
and sharing in its success over time.
Speculating, on the other hand, is more akin to gambling.
Oh, okay.
It's about betting on short-term price movements,
Mm,
often driven by rumors, hype, or emotional reactions.
and that can be dangerous.
It can be very dangerous, especially if you don't fully understand the risks involved.
So is Graham saying that speculation is always bad?
I don't think he was saying that it's always bad.
Okay.
There might be times when calculated speculation can be part of a well-rounded portfolio,
Okay.
but it should never be your primary approach.
And you need to be very clear-eyed about the risks involved.
Absolutely.
So I think a key takeaway for our listeners is before you make any investment, ask yourself,
Yeah,
am I approaching this as an investor?
right.
Carefully assessing the fundamentals.
The long-term prospects.
Or am I getting caught up in the excitement
The high.
and speculating on a hunch?
That's a great question to ask yourself because it's easy to get seduced by the allure of quick profits.
Especially in today's fast-paced world.
Exactly. But as Graham reminded us, The true path to financial success
Yeah.
lies in patient, disciplined investing.
Not in chasing speculative gains.
It's about building wealth steadily and sustainably over time.
Not trying to get rich quick.
Exactly.
And that requires a different mindset,
It
a
does.
different approach than what's often portrayed in the media.
Yeah, all those headlines about, the next big thing.
Right.
It's about discipline, patience, and a commitment to sticking with your principles.
Even when the market is testing your resolve.
Exact.
And that's what the intelligent investor is all about.
It is.
It's a guide to developing that mindset
That long-term perspective.
and that unwavering commitment to sound investment principles.
It's a book that can truly change the way you think about money, investing, and building wealth for the future.
And as one of the blog posts mentioned,
Yeah.
it's a book worth revisiting over the years.
Absolutely.
As you gain more experience and your understanding evolves.
It's not a one-time read.
It's a companion on your vesting journey.
I love that.
Me too.
Yeah.
All right, so we've covered a lot of ground in this second part of our deep dive.
We have
We've delved deeper into some of Graham's key concepts,
explored the psychological side of investing
talked about the importance of having a clear investment philosophy.
and the distinction between investment and speculation.
It's been a fascinating exploration of Graham's timeless wisdom.
It has. Yeah, it really has been fascinating. As we've been kind of unpacking all this, going through all these ideas, it's striking to me that, Graham wasn't just giving us some stock picking formula.
Right.
It was really more like he was laying out this whole philosophy for thinking about money and markets.
Yeah, it's like a whole different way of looking at things.
Yeah. Yeah. And the intelligent investor, it's not just about crunching numbers or, analyzing spreadsheets.
Right, it's about developing a mindset.
Exactly. A mindset that helps you navigate this whole crazy financial world and all the pitfalls.
Yeah, because there are a lot of pitfalls.
So many.
And Graham, he really nailed it when he talked about how our own psychology can be our worst enemy.
Oh, yeah.
All those emotions and biases.
And all those ingrained behaviors.
That can lead us to make really bad decisions.
Even when we have the best intentions.
Even when we think we're being rational.
Exactly. And, we talked about that analogy of Mr. Market before.
Yeah.
And I think that's such a powerful way to illustrate this point.
So remind us again about Mr. Market.
Okay, so Mr. Market, he's not some all-knowing oracle who's dictating prices.
Right.
He's more like this reflection of our collective emotion.
Oh, okay.
Swinging back and forth between euphoria and despair.
Yeah.
Often with very little connection to the underlying value of businesses.
So it's like he's driven by fear and greed.
Exactly. And Graham's genius was in recognizing that you don't have to play that game.
You can choose to step back.
Detach yourself from the emotional roller coaster.
And make your decisions based on a more objective assessment of value.
Exactly. And sometimes Mr. Market is going to offer you a ridiculously low price for something because he's panicking.
Okay.
And other times he's going to demand an outrageous price because he's caught up in the hype.
So it's about recognizing those moments when he's being irrational.
And having the discipline to act accordingly.
It's like having a superpower.
It is. It's like being able to see through the noise and the chaos.
And make decisions based on logic and reason.
Exactly. And now one of the strategies that Graham recommended for maintaining that discipline was to develop a clear investment philosophy.
Okay.
A set of principles that you can rely on.
Yeah.
No matter what's happening in the market.
It's like having a compass to guide you.
Exactly. And that philosophy should be based on a deep understanding of yourself, your risk tolerance, your time horizon, and, your overall financial goals.
Oh, it's really personalized.
It is. It's not about following someone else's rules blindly.
Right.
It's about figuring out what works for you.
Now, Graham also talked a lot about the importance of distinguishing between investment and speculation.
He did.
And he drew a pretty clear line between those two approaches.
He did. So for Graham, investing was about partnering with a business.
Okay.
Becoming a part owner and sharing in its long-term success.
So it's a long-term gain.
It is. Speculation, on the other hand, is more about betting on short-term price movements.
Okay.
Often without really understanding the underlying business.
And that can be risky.
Very risky. It's like gambling.
Yeah.
And while, sometimes speculation can be part of a well-rounded portfolio, it shouldn't be the main course.
Yeah.
You should really focus on investing.
So how can we apply that distinction in today's market, which, some would argue is even more complex and fast-paced than in Graham's time?
That's a great question. And I think it starts with, just asking yourself some honest questions before you jump into any investment. Like what are your motivations? Are you doing this because you think you're going to get rich quick?
Okay.
Or do you really believe in the long-term prospects of this business?
And have you done your research?
Exactly. Have you actually taken the time to understand the fundamentals?
Or are you just following the crowd?
Or reacting to the hype?
So it's about being honest with yourself.
And making sure that your decisions are aligned with your long-term goals.
Not just driven by those short-term impulses.
Exactly. And, true wealth creation, it takes time.
It does.
It takes patience.
Yeah.
And it takes a disciplined approach.
It's not about timing the market.
No, it's not about trying to find that one magic stock.
It's about making informed decisions.
Based on a solid understanding of value.
And then letting your investments compound over time.
And that's what the intelligent investor is all about.
It is. It's a guide to developing that mindset.
That long-term perspective.
That unwavering commitment to sound investment principles.
It's about becoming a more thoughtful investor.
A more discerning investor.
And ultimately a more successful investor.
So as we wrap up this deep dive,
Yeah.
I want to leave our listeners with one final thought.
All right.
The journey of an intelligent investor, it never really ends.
It's a lifelong pursuit.
It's about continuous learning.
Adapting to new market realities.
And just constantly refining your approach.
And you don't have to do it alone.
Right. There are so many resources available to help you.
Books, articles, podcasts.
Online communities.
Financial advisors.
Yeah, the key is to be proactive.
Seek out the knowledge you need.
And never stop learning.
The market is always evolving.
But the principles of sound investing,
those remain timeless.
Well, thank you for joining us on this deep dive into the world of Benjamin Graham and the intelligent investor.
Yeah, thanks for having me.
It's been a pleasure.
It's been fun.
And we hope you found it insightful.
And empowering.
Happy investing, everyone.
Happy investing.